Now we have to go away and do the biggest part of this section, and that is the deferred tax calculation. It's also the most complicated part, but it is the part that's also going to count for the most marks, and there are lots of easy marks to be earned as well. So I'm going to now breeze to a separate page, and I'm going to do the deferred tax calculation. So remember, you need 4 columns: carrying amount, tax base, your temporary difference, and your tax, which I'm going to clearly make DTL or in brackets DTA. That's the way I choose to do it. So let's just unpack how I'm going to prepare this table. I always choose to show assets as positives and liabilities as negatives under the carrying amount and the tax base columns. So if it's an asset, it'll be a positive. If it's a liability, it'll be a negative. That's what I choose to do. When I get to the temporary difference column, I then go with the maths. So if it's a positive minus a positive, it possibly still equals a positive. But if it's a positive minus a bigger positive, it'll then give a negative, and then I just go with the maths after that. Because at the top of the column, the DT column, I've clearly labeled DTL with no bracket, DTA with a bracket, you can't make a mistake. Okay, make sure you put down what they are, DTL or DTA with a bracket, because otherwise the examiner's not going to know. The other way of doing it is you can always just label it DTA, DTL, but that I think is a bit time consuming, so I'd rather you didn't do that. Right, okay, so let's identify our items that need to go into our DT calculation. Now sometimes the trick is to figure out what needs to go in the DT calculation. Remember, you're following the statement of financial position approach, which means only SFP accounts go in and only assets and liabilities. So you can immediately rule out things like retained earnings, share capital, because that's equity. It's not assets and it's not liabilities. So the only assets and liabilities that go in are those on which you know you've got temporary differences. So for example, you know PP&E has got temporary differences on it, so they're going in. But in this question, we were also given inventory. We weren't told anything else about the inventory. If we're not told anything else about the inventory, there's no temporary difference on it, and therefore you don't need to put it into your DT calculation. So really what you have to do is go through all the assets and liabilities in the trial balance and figure out which of those have got a temporary difference on them. Okay, one of the biggest mistakes that students make here is they forget to put in temporary differences. So try not to do that, because sometimes they are a little bit hidden. They're not so easy to find. Okay, so we're going to start with our PP&E assets, because those are the easiest ones to start with. So we've got plant and machinery. Then we've got our investment property. And the investment property I'm going to split between land and buildings. And the reason why I need to do that is because the land will be at CGT rate, but the buildings will be at normal tax rate. So I need to show them separately. But in turn, I'm then going to split the buildings into up to historical and the capital gain. So a little bit messy, the building, but it's the better way of doing it. Again, the capital gain on the building will also be subject to CGT. Right, motor vehicles is our third one. And then we've got the lease, we've got the provisions, and that in fact was all in this question of our temporary differences. In any question relating to tax, look for things like trade receivables and the allowance for credit losses. That's another common temporary difference that you could get. Possibly inventory, if there's been a change in accounting policy and SARS hasn't accepted the change in accounting policy until the current year. Previous years would then be a temporary difference. But these are the more common ones, and most of these you should have come across already. Now, normally, if you had done a PP&E note, you would just pick the carrying amount of the machinery, etc., up from your PP&E note. But remember, we haven't done the PP&E note yet, so we are going to have to calculate these figures. there's lots of marks. So typically, to do the calculations, you will earn marks for the calculations, and then for using your possibly even incorrect figure in the right place, you will get the benefit of marks there as well. So the DT calculation is always worth significant marks, and lots of them are easy marks, especially if they're just method marks for using your wrong answer, but using your wrong answer correctly. You're going to get the benefit of the method marks, even if you do make the odd mistake. Okay, so now I'm going to have to do quite a few additional calculations. So I'm going to have to calculate the tax base and the carrying value of plant and machinery to begin with. Now, what my suggestion is as well is that do each line completely first, because if you run out of time, you don't want to have done some stuff half completed and then you don't get the benefit of any marks because you didn't complete that line. So rather do plant and machinery completely, then move on to the next one, because that's the way you're going to maximize earning your marks. Right, so we need to calculate the carrying amount of plant and machinery first. So basically we take the information we were given at the beginning of the year. So we were given cost 3125. We were given opening accumulated depreciation 937,500, and then we calculated this year's depreciation 312,500. So cost, opening accumulated depreciation, current depreciation, subtract both of the depreciations. Whoops, I made a mistake. Let me just quickly fix it. What was the figure? 312,500, and close the bracket, and that equals your carrying value, which came to 1,875,000. And now you need to do exactly the same, but from a tax perspective. So tax base of plant and machinery, and we start with 3125 times 20%. I'm going to tell you why 20% now, and therefore it equals 625,000. Let's calculate the tax base of the plant and machinery. 3125 times 20%. Why 20%? We're in the fourth year of the use of this asset, therefore only 20% of the tax base is still left. We've already deducted the balance of 80%. So the easiest way to calculate it is just to say what's left. 3125 times 20% equals 625,000. We've got both of those figures. We can go back to our DT calculation and pop the figures in. So 1,875,000 under carrying amount, 625,000 under tax base. They're both assets, so they're positives. The temporary difference is 1,250,000, and times 28% is 350,000. And I leave it as a positive because it's a DTL. Why is it a DTL? Let's just remember your rules. And guys, the rules are so important, but the most common rule is rule number 1, which is this: carrying value of asset greater than tax base of asset, therefore a DTL. If you know the first rule, rule number 1, you should be able to work all the other rules out. You don't want to make a mistake on things like that, because just to give you an example of how marks would be awarded here, is you would be awarded probably half a method mark for the 1,875, half a method mark for the 625, and half a method mark for the 350. So if you've applied your logic correctly, even if your figures are wrong, you could still get 1.5 marks. If perhaps you made a mistake in your calculations, you could still get some of the method marks. Okay, investment property. The land for investment property is quite straightforward, because it's the fair value at the end of the year is the carrying value, because remember it's now investment property. The original cost will be the tax base. So the difference is your temporary difference, but very NB, that temporary difference must be multiplied by 80%, because remember 20% is exempt. So even though the difference there, you can see 220 minus 175 is 45K. 45K is not the temporary difference. Only 80% of the 45 is the temporary difference, which comes to 36,000, because the other 20% we exempted in our current tax calculation. So 36,000 is the difference, multiplied by 28% gives us 1080. Right, now the building. I'm actually just going to write the figures down for the building first before I unpack them. It's just going to be a little bit easier. So 1240 goes in under historical, 110 goes into capital gain, and then 1116 goes into the tax base. The 1116, the tax base, we have to calculate, so I'm going to do that calculation. But the carrying amount, the two figures, are quite straightforward. The up to historical cost is the historical cost, 1240, that was given in the question. Anything up to 1240 is going to be taxed at 28%. So that temporary difference between the 1240 and the 1116 is going to be at the normal tax rate of 28%. Because SARS is giving you tax allowances on the building. Because he's giving you tax allowances, any tax effect will be at 28%. But his allowances are calculated on cost. So anything above cost will be subject to capital gains tax only. And that's the 110,000 fair value adjustment that we did and the revaluation that we did on the property in the current year. So the 110,000 has nothing under the tax base column. Again, 80% of it only is the temporary difference, and that will then be multiplied by 28%. So 24,640. Okay, so what I just need to do is I need to go through the calculation of the 1116 tax base with you. So let's just go and do that calculation. It is quite short and sweet. So the cost was 1240, and what allowance would SARS give? SARS would give 5% per annum for each year. And remember, this being 2 years. So 1240 minus 5% for 2 years. And that gave us therefore the tax base of 1116. Remember, he doesn't apportion it for periods less than a year. So even though it was acquired during the year, we get the full tax base. Right, so that was investment property. Let's move down to motor vehicles. Motor vehicles, we've already calculated the depreciation on it for the current year. The motor vehicles were acquired in a previous year, so it's the original cost 1596 minus 2 years worth of depreciation, which will give us the carrying amount. And remember, SARS doesn't recognize the motor vehicle, so tax base will be 0. So let's just do the depreciation calculation for the motor vehicles. Depreciation motor vehicles, it would have been the 1596 minus 20% for 2 years. And that gives us an answer of 957,600. So back to our table, 957,600. Nothing for tax base. Temporary difference there for 957,600. And the DT at 28% is 268,128. And we're still working on rule number 1, because in all instances here, the carrying amount of the asset is greater than the tax base of the asset. Right, last couple, the lease liability. The lease liability we don't even need to calculate, because in the question we were given the table. So all we do is we go to the table and we say, fine, what was the balance of the lease liability at the end of the current year? And we already highlighted it. The figure was 1141862. It's liability, so I need a bracket. Nothing under tax base because SARS doesn't recognize it. So the temporary difference is the full 1141862 with a bracket. And 28% of that comes to 319721 with a bracket. And why is it a bracket? It's a bracket because one of my different rules is creeping in now. Now I've got a liability. So carrying value of liability, 1141862, is greater than tax base of liability, 0. Therefore, it gives rise to a DTA, not a DTL. And lastly, the provisions. 350,000, sorry, my alignment is a little bit off here, but you can still see what I'm doing. 350,000. Again, tax base is 0. So 350,000 under temporary difference, and times 28% equals 98,000. And once more, that is a DTA because carrying value of liability is greater than tax base of liability. Now that's the main DT workings done to calculate your balance. So this part of the question is significant marks, and it's worth doing properly. A lot of it is method marks, so you need to make sure that you do the marks well here. Right, let's add it up. You only need to add up the last two columns. So 963,738 is our temporary differences, and the DT balance 269,847. Okay, so what do these two numbers mean? Okay, the 269,847 is your DTL that is going to be disclosed in your statement of financial position. Remember, part 3 of this question asked for the DT note. So that note is going to be the breakdown of the 269,847. In fact, it's going to be as easy as you just take the column, the DT column, you list all the temporary differences, and it will add up to 269,847. So that note is going to be very straightforward. The 963,738 is your closing cumulative temporary differences. Now we're going to use that figure to assist us in calculating our temporary difference movement for the current year that we need to put into our current tax calculation. So what we have to do is we have to subtract the opening figures. So this is closing balance. We subtract the opening balance. But remember what I told you earlier on when we were looking at the question. I said to you, separate out the deferred tax asset from the DTL opening balance. It was 205,537. What I'm going to do is I'm then going to add back the DTA in respect of the assessed loss. And that will give me the opening DT balance excluding the assessed loss. So it comes to 247,537 was the balance, and to get the temporary difference I then just divide by 28%. So 247,537 divided by 28% equals 884,061. And this is also a deferred tax liability. So very importantly, the figures that I'm most interested in is the difference. 79677 and 22310. But let's just unpack the figure. We've got a closing cumulative taxable temporary differences of 963,738. Remember, taxable temporary differences give rise to a DTL. We've got an opening cumulative taxable temporary differences of 884,061, also a DTL. So simplistically, my DTL is getting bigger. So the 79677 is additional taxable temporary differences because it's resulting in an increase in the DTL. So the 79677 is my movement in my temporary differences that I want to be able to use in my current tax calculation. But there's one slight snag first. So up until now, it was actually reasonably straightforward, to be honest. But our problem now is that the 79677 is temporary differences that relate to items in P&L, but also items in OCI. And that's the pain. And if you think about it, up until now, I haven't even thought too much about the OCI being the revaluation of the land and buildings that were transferred. But now I have to, because some of the 79677 is not going to P&L, it's actually going to the revaluation surplus. So what I'm going to do is I'm going to do a calculation to break down the 79677 into the figures that are going to P&L and the figures that are going to OCI. So it's that figure that I want to break down. And so we're going to do a separate calculation to break those figures down. Right, so let's have a look at it. Just find a blank one. Right, so it's the 79677. And what we want to do is we want to split it between P&L and OCI. Okay, the easiest way to do it is to do the calculation for OCI first. OCI relates to the land and buildings. So I'm going to do two simple little calculations to work out the DT on the revaluations. Do land first, because it's the straightforward one. So land, the original cost was 175,000 and the market value was 200,000. So 200,000 minus 175,000 is the revaluation that took place when it was transferred to IP. But remember, only 80% of that is subject to tax and times 28%. So the temporary difference that arose and the deferred tax that arose on the revaluation comes to 5,600. Right, the land was quite straightforward. The building is a little bit more complicated because of the fact that the building, there was a tax allowance on it, and there is also capital gains tax because the revaluation is now going to take us above cost. So the building is just going to be slightly more complicated than the land. Okay, again, remember we're working with the values on 31 December and the carrying values on that date. Okay, so let's have a look at it. Up to cost, just going to call it cost because it's easier. This will be at 28%. It'll be 1240 minus the carrying value, which was 1209 minus 31,000. I've just done the figures as round thousands. It's just because I'm running out of space. So it's just easier for me to do them as round thousands at this point in time. So that difference comes to 62,000. And let me just unpack this a little bit better. So what we're saying is this building's been revalued. The revaluation has gone to OCI. We need to know the tax implications on that. But the tax implications are a little bit complex because SARS is giving a tax allowance up to the cost. So that's why I do a cost calculation, because the DT on that will be based on 28%. Then the rest of the temporary difference, which is above cost, will be at the CGT rate. And so I'm going to split it into those two components. So this comes to 62,000, and that will be taxed at the normal 28%, which comes to 17,360. The other part of it is easy because it's just the gain, and it is just the difference between the fair value on 31 December, which was 1.3 million, minus the original cost. Again, remember, I've just done those figures in round thousands. That comes to 60,000, but only 80% of that is taxable, 80%, and then times 28%. So the tax on the capital gain section is 13,450. So basically, what we now do is we add up all three tax figures that we've calculated, and that is the DT that has gone to OCI. By just dividing about 28%, we can then work out the temporary difference that has gone to OCI. So now we've calculated the deferred tax on the three revaluations for the current year. So these three figures together is going to be the DT on the revaluations for the current year. But remember, we don't want the DT, we actually want the temporary difference. So what we're going to do is we're going to add up the three figures. So it's 56 plus 17,360 plus 13,440, and that comes to a total of 36,400. And then all we're going to do is we're going to divide this figure, 36,400, by 28%, and that will give us the original temporary difference. If you take 36,400 and divide it by 20%, it comes to 130,000. So 130,000 is our temporary difference that has gone to OCI. So that's what we're going to use to calculate or to use to help us work out the temporary differences that have gone to P&L. So let's go back to, let's stay on this page. So what we're saying is the 79,677 was the total temporary difference movement for the current year. And remember, that's a DTL. Of that, 130 relates to also DTL, because revaluations are always DTL, that has gone to OCI. So the trick here is the fact that actually our DT movement that has gone to P&L is in fact a DTA, not a DTL, because the DTL that's gone to OCI is bigger than our net movement. So let me just work out the figure first of all. Okay, the difference between those two figures, 130,000 and 79,677, comes to 50323. Just write it down like that, 50323. And that is going to be a deductible temporary difference in our DT calculation, not a taxable temporary difference. It's a deductible temporary difference because of the fact that the OCI movement was a bigger than the total movement. Now that we've got all those figures, we can actually finish our DT calculation. Okay, but before I go back and finish the DT calc, this part of what I've just done is complex, okay? And not many students are going to get this. And it's not worth a lot of marks. So don't get bogged down by all of this if it's just too much for you. Yes, you could lose 5 or 6 marks, but the time you take to do this is probably not worth it in the long run because you've probably made a mistake somewhere as well. So really, don't get too bogged down by this. This is the hardest part of this question, and you don't want to waste time on it unnecessarily. Okay, so let's go back. Let's put it into the DT calculation. So 79677, I'm now going to just erase. There we go, 79677. So what I'm basically now saying is the DT movement to OCI is 130,000, and therefore the DT movement to P&L is 50323, and that's DTA, in other words, a taxable temporary difference, 50323. And now you can actually go and finish your current tax calculation. So I'm going to go back to it. Here it is. So 420,300 was where we ended in terms of our current tax calculation so far. So all we do now is we put in our deductible temporary differences, because remember, deductible temporary differences is what creates a deferred tax asset. So deductible temporary differences are 50323. And remember, it is rather illogical, but a deductible temporary difference you add when doing your current tax calculation. And I know it's illogical, but unfortunately, that's the rules. Okay, it's deductible in the future. That's why it's called deductible, but you add it now. So that gives us taxable income of 470,623 and tax of 131,775. But don't forget, we've got a tax loss brought forward. So before we calculate current tax, we're going to deduct the tax loss brought forward, which was 150K. And the tax on that is 42,000. And therefore, taxable income is 320,623, and current tax is 89,774. And that is part 2 of the required. It's a lot of work. Quite a lot of the work that you've done will help you in part 3 of the question, especially the first few parts of part 3. This part of the question probably was about 20 to 25 marks at least. So you are going to take about half an hour to do it, and there are some complexities, but there's also some easy marks to be earned. Yeah, so once you finish your current tax calculation, you're then moving on to part 3 of the question, which is presentation and disclosure.